everyone, and welcome. Thanks for joining us today for our conversation on the state of enterprise software. We're really going to try to dive into what it means for AI, venture capital, and really startup strategies for 2025. My name is Rob Helm, and I lead our enterprise software and relationship management team here in Northern California. Quickly go to the next slide. A couple of housekeeping items to go through before we dive in. So all lines are muted. You can close the closed captioning feature by clicking the live transcript button on the bottom of your Zoom site. We will be using the Q&A function, so feel free to ask questions as we go throughout this conversation, this presentation. And we will also be sending out a link to not only the recording of today's webinar, but also the full State of the Enterprise report that we just published a couple weeks ago. So go to the next slide, please. Here's a quick look at the agenda for today. So we'll start with an overview of a few key takeaways from that SVB State of the Enterprise software report. We'll then move into a live panel discussion, and we'll follow that up with Q&A from the audience as well. So next slide. So joining me today, I've got awesome crew. Andrew McCarty, Senior Vice President with our enterprise software team. He was one of the key authors of our report. We also have Emma Eschweiler, Director with our venture capital and corporate relationship team. Joined by Darren Kimura, CEO of AI Squared, and Dave Mullen, partner with Pinegrove Venture Partners. So we'll start by kicking things off, and we'll hand it over to my colleague, Andrew McCarty, who will walk us through a few of the slides from the report and help ground the conversation. So with that, I'll pass it over to Andrew.
Thank you, Rob, and thank you to everybody on the line for joining us today. We're excited to dive into the report. I'm Andrew McCarty. I'm a vice president on our enterprise software team out here in San Francisco, working with companies from seed to pre-IPO. And like I said, we're excited to dive into some of the themes that we feel are most relevant to operators and founders. And we'll start by going to the next slide here and digging into VC fundraising. And to me here, honestly, what the most important takeaway that we see, and one of the most important factors driving a lot of the trends that we're going to talk about today is this big gray bar. And quite simply, the extent to which VC fundraising has declined over the past couple of years since the peaks in 21, 22, and then subsequently the end of the ZIRP environment. And it's no secret that a lot of the investments kind of leading up to that have taken a beating over the past couple of years. And within that context, we've seen LPs really seeking alpha by going to the largest funds that are out there, these funds of $500 million or more, which are really the name brand funds that we all know. There's been some maybe surprising resiliency among the emerging manager cohort, which is awesome to see, and makes sense from the standpoint that those investors have more of an opportunity to specialize and perhaps see around corners that more generalist investors might not. Where we've seen a real hollowing out, though, is from these mid-stage investors, where LPs who had previously been investing in those types of funds are now funneling capital towards these large funds that can really effectively index the market. And as we'll see here, that has a lot of downstream effects throughout the ecosystem. We can go to the next slide here. And what we see is that LPs have been reallocating capital not just towards the largest funds, but also really drastically over the past couple of years towards AI. On the left here, we see that 4 out of 10 venture capital dollars, or 4 out of 10 dollars that were committed to venture capital funds went into funds that were explicitly listing AI as their focus. And then on the right here, we see that over a third of funds that listed AI as an explicit focus were oversubscribed, as opposed to only 9% of funds that didn't have AI as a focus being oversubscribed. As you can see here, those trends are going in some very different directions. We can go to the next slide here and want to turn the lens from VC fundraising to VC investment. And one of the real themes that we talk about and allude to throughout the report is how we really feel as though AI represents a platform shift, and one that we're definitely still in the very early innings of. A platform shift that really dwarfs the impact of anything we've seen since at least the inception of the internet. And this graphic is a real gut check to that. And obviously, looking at the percentage of VC investment going towards a technology is a bit of a narrow and imperfect way of looking at the impact of that technology. But I do think it's notable that we're already seeing, at least in terms of percentage of overall investment, AI start to eclipse some of these earlier technological shifts. And looking at the way it's trending, we expect that to continue. Um, the other thing that I think is important to draw attention to here is, how while we all felt the pullback of investment from 2021 to 23, there has been an overall increase in investment in sequential quarters since 2023. And that's notable, that's important. But if we go to the next slide, I think it does mask uh, another shift that to me was surprising, not directionally, but the extent was surprising. And that's how much concentration there's been in capital towards mega rounds. So we see here on the left, 68% of capital that went into US enterprise startups went into deals of $100 million or more, which is kind of the benchmark we're using for these mega rounds. And I mean, that's stark. That is a ton of capital being allocated to a relatively small amount of companies, and it's creating this sort of two-tier dynamic that we hint at throughout the report, where capital is abundant and cheap for these, the XAIs, the OpenAIs, the Anthropics of the world, these huge companies building core AI technology that are commanding massive equity rounds. And capital is becoming much scarcer for everybody else out there. Um, and this is also directly the result of the dynamics that we talked about earlier, right? We're seeing LPs allocate funds increasingly towards these, allocate capital towards these mega funds, and these mega funds are then in turn able to make these large concentrated bets on these large, hyper growth companies. Quickly on the right here, I think this is notable, in particular, seeing the resiliency of mission critical verticals like cybersecurity and infrastructure. And as we see the tech stack continue to get reconfigured in the coming years, expect that the resiliency of these verticals to continue. I'm also cognizant of the fact, seeing the decline in application investment. I think a lot of that is probably just, the AI investment is applications probably being recoded a lot. And that does get at, kind of similar point, which is that, we kind of look at or treat AI almost as a separate vertical here in the report. And I think there are good reasons for that. But really, I think the reality is that we're approaching an environment where, AI isn't its own separate vertical. It's intertwined with all these other cybersecurity infrastructure applications, all these other verticals that we're seeing. So going on to the next slide and thinking more about the allocation of capital, what does this mean for the Series A and seed graduation rates? And quite bluntly, it's meant a collapse in seed graduation rates. I'd like to call attention here in particular, 2023 cohort, still less than 10% of companies have graduated to the Series A. And again, this is directly the results of this hollowing out of capital from the kind of middle tier funds who would normally be raising and leading Series A's, Series B's, Series C's. And now those funds are much more scarce. And so as a result of that, we're seeing the goalposts for companies to raise a Series A shift pretty considerably. In 2021, the median company raising a Series A had just shy of $1.5 million of revenue. Now that medium company has $3 million of revenue. And so, we're seeing companies take longer to scale to those benchmarks, trying to do so more efficiently, of course. And as we'll discuss in a little bit, being more open to exploring acquisitions along the way at an earlier point than they would have in years past. Moving on to the next slide and taking a quick look at some of the financial benchmarks. Unsurprisingly, we've seen revenue growth across life stages pull back over the past couple of years. And this is a result of all the things we know that the folks on the line have been seeing out in market, right? Procurement decisions are getting stretched, budgets are getting slashed, and there's more of a need to demonstrate mission critical value to potential customers. And so this reality in combination with, again, the scarcity of capital, comparatively speaking, for those who aren't raising those mega rounds, has led to a much more conservative spend management and pullback on burn across the board in 2024. Moving to the next slide. And this is one that we're excited about because we had the opportunity to shine the light to our own portfolio here, and we wanted to see what a cohort of the top quartile of our borrowers, after polling our credit team across the country, and putting together a cohort of top quartile borrowers. We wanted to see what that looked like. And when looking here at these metrics in logo and ARR, churn and growth, what we see is that the metrics and benchmarks for this top quartile really compare favorably with what we've seen in the past, which is exciting, and I think reinforces the idea that multiple things can be true at once, right? Like, yes, it is absolutely true that it is a harder world out there, a harder environment for companies to grow and raise capital. But the flip side of that is that the companies that are able to raise capital and scale their businesses are doing so on the heels of more efficient growth, strong product market fit, much more efficient metrics, and all of this means that we're really excited about the crop of companies that we see continuing to grow right now within our portfolio. Finally, here, going to the next slide, and quickly thinking about exits. It's no secret that we need exits to recycle capital back into the ecosystem. The LPs are hungry for that. It's also no secret that the IPO window has been shut largely for quite a while now, with some exceptions here and there. And so M&A is really the off-ramp that we're looking for companies to see exits and for capital to get recycled into the ecosystem. And there have been, certainly here looking at this graphic, there's been an uptick in M&A over the past couple of years since 2023, since the pullback from the heights of 21. Really, there have been some highlight acquisitions there, thinking of Wiz and Alphabet, thinking of Informatica and Salesforce, right? Some big headlines. But, looking here at the right, I think it hints at the fact that there's, a lot of motivation among the more established players who are AI or AI adjacent, to really, build out their team and tech and talent, and build or strengthen their moats by acquiring companies, not just, the headline late stage companies, but more early stage as well. And this is driving a dynamic, which we'll see on the next slide, where looking here at the bottom in 23 and 24 and 5, we see a real spike in seed and pre-seed acquisitions. And this, again, not to beat a dead horse, is directly the result of there being, much less funds for the types of venture capital firms that would have traditionally been raising and leading Series A, Bs, and Cs. But then also the fact that there are plenty of motivated buyers. And anecdotally, when we're out in market and talking with founders, there seems to be much more openness to entertaining exits at that kind of seed Series A time frame, when before, I think the strong temptation would have been to keep building the business. So we see a real kind of confluation of motives here from the startup and the acquirer side. And all this leads us to believe that we're going to experience a really healthy M&A market going forward as the sort of needs of all players here align. So with that, we'll move on to the next slide, and I'll pass it over to Rob and our panel to dive into these themes and more.
Thanks, Andrew. Great insights, a lot to unpack there, but I really think about this in terms of of the venture ecosystem in transition right now, with AI really being at the center of that. Funding dynamics are reshaping the venture landscape as a whole. And then I think, as you touched on at the end there, exit's still really hard to come by today in this market. So let's bring in our panel to explore what this all means in practice for investors, founders, executives in the broader tech ecosystem. So we're lucky to be joined by an exceptional group here. And I'll start with Darren. Can you give us a quick intro and a few words about your company?
Sure. Hi, everyone. I'm Darren Kimura. I'm the CEO of AI Squared. We're a Series A software company founded in 2021. We're focused on enabling enterprises to seamlessly integrate AI into their environments with minimal effort. An example of what we do is we recently helped a financial services firm operationalize AI models by reducing the development cycle by about 40%. I'm excited to be here today. Thank you.
Awesome. Emma, quick intro and your role at SVB.
Thanks, Rob, and Andrew, great job sharing the report. Hi, everyone. My name is Emma Eschweiler. I'm a part of the SVB team going on 12 years with the organization. And my role at the bank is investor coverage and business development, focused on VC relationships, corporate VC relationships. And really, my team sits nationally. We work across a broad swath of folks. yeah, I really enjoyed my time here at SVB. Excited to dig into some questions.
Great. Thanks, Emma. Dave, quick intro, a few words about Pinegrove.
Yeah, thanks, Rob, and resounding Emma's comments about Andrew. Great job with the overview. I'm Dave Mullen. I'm a partner at Pinegrove Venture Partners. We're a venture asset manager founded in 1999. We serve the community across fund of funds, credit, and secondaries. Happy to talk to any funders or founders after this where we can be helpful across any of our products. Thanks for having me.
Great. So let's start, I guess, at the macro level. And, I think the quick backdrop for 2024, we saw heightened geopolitical tension, inflation, uncertainty, slow enterprise spend. 2025, we now have tariffs and market volatility entering the market. Yet at the same time, we see the VC investment jump 30% year over year. So pretty contrasting there. But Dave, maybe starting with you, what's your current view right now of the state of the venture market? And then if we think about sort of the second half of 2025, where are we going?
No, there's a ton to unpack here. I think the key word is really uncertainty. There's a lot of variables going on, public markets, geopolitics, IPO windows, lack thereof, the AI race, domestic global competition. I think really the key word to kind of hone in on is uncertainty. That being said, I think we all operate in a segment of the economy, venture innovation, that really benefits from dislocation. I think a lot of this is converging at the right time. And so a ton of opportunities, as we've seen with VC investment jumping 30%, a lot of that being concentrated in AI and mega deals, which we'll go into a little bit later. But I think what's underpinning a lot of the questions today fundamentally comes down to liquidity and what we're seeing from fundraising, both from funds as well as companies, and the dynamics between the two. I know we'll talk a little bit more about this later on, but for me today, what I'd really like to hone in and unpack for people and frankly get Emma and Darren's opinion on is just what exactly is going on and what we as LPs are looking for over the next 12 months.
Yeah, and I think, maybe quickly before you get to other perspectives, but, Pinegrove has a unique perspective, right? The fund of fund strategy. So you're evaluating a lot of the funds that are out there and kind of assessing what their strategies are going to be. If you think about sort of the consolidation of LPs around AI-focused managers today, how is that affecting your guys' impacting your fund of fund strategies and how you guys are thinking about, the funds that you guys are backing?
That's also a good question. And I think Andrew actually hit on a really good point earlier, which was, AI is really touching everything. It's across sectors, across functions. What is AI as it pertains to an AI fund or an AI company even? I think an interesting parallel there is, 10, 20 years ago, what was tech versus the rest of the ecosystem? Now tech is helping build companies across sectors, be that real estate, be that financial services, be that how we've traditionally thought about tech, the FANG platforms. And so for us, the way we've always thought about it is less about necessarily what are the best AI funds or who's getting into the best AI deals. That's important and that's something we've thought about, but it's more about GPs at the end of the day. Who are the investors? Who are those that are resonating with founders? Who are those that are adding value in unique ways? Another kind of point of conversation is, with the amount of capital that AI companies are requiring, are the multi-stage investors the ones that are positioned to win over time? Are they the only ones that can play in this space because they can write the checks that these platforms need to grow and scale and frankly compete in today's environment? And I'd say no. I think a lot of that is the way GPs are getting creative around winning deals, winning founders, is that providing GPU access or infra credits or unique ability to source or go to market or what have you. Tying that back to your question, I think AI is an important part of the conversation. What are you doing? How are you thinking about that? What is your unique point of view? But at the end of the day, we are in the business, on our fund strategy at least, of backing the world's best GPs and investors. And so that's the first question we're looking for over, say, kind of accommodating our portfolio construction for something that's more AI centric.
Right. Emma, going back to sort of the macro question, given SVB's vantage point across tech startups and general partners at the venture funds, how are startups navigating the macro uncertainty today, like tariffs and market volatility?
Yeah, well, so I'll answer sort of the narrow question around tariffs pretty simply. I think in the enterprise market, we're not dealing with first order effects. We don't have goods crossing borders. We are dealing with second order effects, right? So a lot goes back to what Dave was saying about uncertainty. It really depends on how the macro environment and the overall economy does, because the second order effects for enterprise software companies are, okay, is my customer going to scale back on expenses? Because now all of my customers' expenses have shifted, right? So there are these knock-on effects that take time to sort through in the ecosystem. And I think we're still in early innings to an extent on those second order effects. But this isn't happening in a vacuum, right? I mean, if you look at venture, founders have had to get creative for several years now, going back to, again, what Dave said around liquidity, right? So in this environment where we're starting to see this barbell effect between sort of these boutique investors, emerging managers, and the asset managers, and the hollowing out of the middle, and the commensurate, to Andrew's point, shift in benchmarks for companies to raise, it's required founders to get really creative on runway extension, to get really creative around expense management. And I think when we first started to see the market doing this a couple of years ago, it was sacrifice revenue in order to stay alive, right? It's all about get that oxygen. And now we're at a point where your revenue does still need to grow. So it's a tough position for founders because you're told for years, hey, manage expenses, but you do need to spend to grow. That's really what the venture model ethos is all about, right? Capitalize early at the beginning in order to make those investments to grow like a hockey stick. So it is a challenging time for founders because you need to be able to do both. From my seat at SVB, navigating this market volatility requires leaning on your advisors, leaning on your board, leaning on your lawyers, your bankers, your service providers to help navigate a bit. But I do think, at least as it pertains to the current market volatility, going back to what Dave was saying about liquidity, cautious optimism with Circle last week. If the IPO markets do open, and we have seen M&A start to warm up a bit, we had predicted in several of our other SVB reports that M&A would be much stronger in the last 2 years than it was. But now we really are starting to see that bear out. We're hopeful that recycling of capital in the ecosystem might ease up some of this tension. But yeah, in the short term, navigating this market volatility, at least tariffs specifically, at least it's not a first order effect for the enterprise world.
Yeah, totally agree. And definitely we're going to double click into the revenue growth versus burn discussion in a little bit. But Darren, from the CEO company perspective, what macro forces, whether it's interest rates or hiring or procurement cycles, are most impacting your go-to-market today and fundraising strategy right now?
Yeah, absolutely. So one thing about AI Squared is we're dual use focused. So that means that we sell into the government and defense, but also into large enterprises. So one of the key ones that we're thinking a lot about is DOGE, and in this case, it's the Department of Government Efficiency. There's quite a bit of uncertainty that Dave mentioned earlier. For example, there's new procurement cycles and new rules that have yet to come out, which have delayed projects and timing and make it uncertain as to when contracts will be awarded. So that's challenging. I think from our perspective, we've seen quite a bit of point of contacts also revolving, people taking packages to leave the government. Those are people that have been working on certain projects for many, many years. So they take with them the domain expertise and knowledge. So it requires us to go back in and re-educate people. So that is something we're thinking about quite a bit. The interest rate environment is quite challenging. It doesn't impact us directly, but it definitely impacts our customers. What we've seen pretty much across the board is all CFOs are scrutinizing every single dollar now, and everyone's asking about ROI and paybacks, which is pretty different than what it's been in over the past few years. And then finally, on the talent side, technical talent hiring is very challenging. Hiring in general is probably easier than it has been 12 months ago. But when we look at things like security engineers, AI engineers, forward deploy engineers, they're still very, very scarce and pretty expensive.
Yeah. maybe just touching on like the customer conversations that you're having, right? And Andrew touched on sort of this precipice of the platform shift to AI. How are those conversations that you're having with potential customers on the ground today, and now how do those compare to maybe what we were having maybe a year ago?
Yeah, it's changed quite a bit. So a year ago, a lot of the conversations were about experimentation with AI, a lot of lab work, PLCs showing simple value based on sample data, isolated pilots. And now it's all about taking that and putting it into a production environment, which is a very, very different environment. So everything is operationalizing. When you shift into a production environment, you have to answer things like cybersecurity and governance, ethical considerations, go through different degrees of software review that you really don't have to worry about in the case of a PLC. So that's the biggest change we're seeing right now is everything going into production, and that brings on top of it all this additional work, time, things slow down. So I think from an investor perspective, what you saw maybe a year ago as things are going pretty fast and you were seeing initial PLC sales that might have been characterized as subscription sales, that may change. The time frame for those cycles may change now because going into production is much, much more complicated.
Got it. Yeah, absolutely. And so maybe shift to a little bit to, I think one of the key themes of the report and what Andrew was talking about is the hollowing out of venture. Obviously, a striking trend of capital clustering at the extremes. We've got very early seed stage funds that are maybe hyper-focused, strategic, able to raise, and then these large multi-stage funds writing $100 million plus checks. Q1 alone saw 107 of these mega deals done. Meanwhile, the mid-sized funds are struggling to raise, and it leaves a potential gap right now in the capital supply chain. So creating new risks for not just like the fund managers that are out there, but also for the startups and the companies that are reason, especially for those companies that maybe aren't a perfect fit for either end of those spectrums. So Dave, get your perspective on this. What are the sort of the implications and the bifurcation of this venture ecosystem overall? And is this something that we see resolving, or is this going to be sort of the new normal for us going forward?
Yeah, it's a great question. I think there's two parts to that answer. So the first is, on the fundraising side, what we're seeing now is no surprise, and we've talked about it several times on this call, is a lack of liquidity. So limited partners at the highest level, those funding this ecosystem, be that sovereign wealth funds or pension plans or even corporates, are dealing with portfolio challenges. On one side of the coin, again, they haven't received distributions so that they can have a self-funding venture program, which means they're limited in terms of what they can do or invest in. The second piece of it is their portfolios have been all over the place with interest rates. And so they deal with denominator and numerator considerations when managing that as well. So what that's resulted in is really what I like to equate as, what we saw with venture investors who are directly investing in 22 and 23, which is focusing on their existing portfolios, making sure their existing funds that are performing are well capitalized, and holding off on net new commitments or evaluating net new managers, until there's a little bit more liquidity and, frankly, certainty in markets. That's really what's driving a lot of the challenges that we're seeing. And again, hopefully in the back half of this year or early 2026, we see a little bit of this liquidity that will ultimately catalyze more funding into this ecosystem. But for now, it is really going to drive the second part of your question, Rob, which is kind of the bifurcation and venture funds that are dominating AI. Spoke to this earlier, but on one end, you have those that can just write massive checks. And you can say inference costs per token are falling, but at the same time, compute costs, energy needs, capital or talent density, as Darren alluded to, are very, very high. In addition, just human nature, if you're seeing leverage on your dollars invested, you're going to see more and more capital being invested there. And so these mega funds winning these very large deals and really circling around what are perceived winners. Then you have the rest of the ecosystem, which are smaller funds, breakout managers, or even just capital constrained managers who are getting very, very creative and winning on that alone. Again, I mentioned this earlier, but we're seeing really unique ways of adding resources to AI founders, be that perspective from being a founder yourself and having built an AI business early on, and or infrastructure, GPUs, go to market, creative ways to build and scale. And so I don't view this as a more systemic, longer term issue so much as over the next few years. But it is one that folks have to be thoughtful about.
Great. And again, Darren, love to get your perspective from the founder, operator, perspective. How does this capital concentration impact companies that maybe are in between these zones, not seed, but not yet that mega growth, or they don't have the business plan that would back a mega growth type of investment? Is there risk that the capital becomes harder to access for solid companies that don't fit the current profile?
Absolutely. There was mention of the barbell effect where you have capital at the seed level and capital at the mega level. And, you hear of companies like OpenAI with their rumored new raise at $100 billion valuation. Those are all capturing the headlines, which is great. But companies like ourselves, for example, which are the ones in the middle, Series A, early Series B companies, especially the ones selling to the markets we sell to, government, as we mentioned earlier, which could be delayed in contracting cycles, or large enterprise, which could be slow because of governance and other factors. So you don't have those breakout metrics just yet. You don't probably have the revenue just yet. There's definitely risk that those types of companies will be starved for some capital, or be challenged for capital. But here's the thing that I think about. I mean, these are companies that may not yet have breakout metrics, but there's a lot of potential. And I think what we're seeing in the world of AI is that it's only becoming clear now of what kind of downstream tools are needed, where the real alpha could be in these companies. So as a leader of these kinds of companies, it's absolutely frustrating, but it's a reminder that we have to stay focused on the metrics that matter and ultimately bringing value to our customers, solving their core problems. That's the key.
Got it. Yeah. And I guess from the operator's perspective, like, how should they be thinking about that in terms of their fundraising strategy? Should they be adjusting things on timing, who they're talking to, different investor targets, capital structures based on kind of this shift? Like, how should an operator be thinking about their fundraising strategy?
I absolutely think that is exactly what you need to do. I think in the past we were planning businesses at the 12 to 18-month cycle. I don't think that you can do that anymore. I think you have to be funding as soon as your last round closes, frankly. I think you have to broaden the investor profile. Investors are out there, but they just may not look like, Sand Hill Road type venture investors. You may have to be going after family offices. It could be a strategic capital from large corporates, for example, their CVC offices, or teams. Could be government aligned capital. And also, non-dilutive grant funding. I think that's also out there and available. Takes a little while, but it helps a lot to stretch out your runway. I think that when you structure, you probably have to be a lot more creative as opposed to thinking you're going to do a preferred round each round. It might be more like safe notes or convertible notes, take advantage of venture debt. I would definitely focus on payment cycles, getting as much payment as you can. Front load your payments, even though you've got a multi-year perhaps subscription. Get all the money up front as to the extent possible. So I would say optimize for flexibility, not the headlines.
Right. And I would double click on that. And Rob, I realized I also didn't answer a question of yours. One, I think Darren brings up a great point in terms of getting creative. I think endowments are dealing with their own challenges. That's one thing we didn't talk about, be that new taxation or some of the headwinds, going on in policy, et cetera, et cetera. But I do think family offices can become that new funding vessel. The other thing that we're seeing is from corporate partners, a willingness to engage and even invest in startups at an earlier stage. So I think 2, 3, 4 years ago, if you weren't a Series C, platform and you hadn't passed all these certifications and there wasn't proof points of you existing in 10 years or so down the road, wasn't really a real conversation. Now we're seeing at the Series A and Series B from very large, credible institutions. So certainly one to look at. To the question you asked, Rob, on the middle of the barbell that I didn't get to, for those funders or GPs on the call, I think there's a lot of creative ways to continue to stay in front of LPs and fundraise. One is co-invest. So leaning into the notion that you may not be multi-stage fund and have these big growth funds, but you are able to pass along opportunities as they progress at the B and the C. That's really interesting for limited partners. The other component is we're dealing again with uncertainty and being in the boots on the ground and the point of view around AI and how that might impact their geography or if it's a corporate, their business is extremely important. Some of the top feedback we've received from our own LPs is, one, you said you were going to do what you were going to do, which is be a strategic partner on the ground. The other piece is, when there's something like, say, a DeepSeek coming out, what is your point of view? What is your perspective that we're able to take up to our own CIO or our own higher ups, whoever that may be? And so I think those intangibles are a real way to differentiate and lean into the strengths of these kind of middle ground, if you will, managers between breakout and multi-stage investors.
Love that. Both scrappy on the operating side and also thinking about even the venture stack. There could be different ways of unlocking to different capital. Emma, maybe just quickly touching. I mean, you obviously maybe have a perspective from the corporate side because I know that's part of your relationship and your mandate here at SVB. But I also want to kind of touch on the kind of one of the things that the report talked on is the Series A graduation rates. Those are becoming much more lower at this point. We're seeing a growing seed stage cohort. From your perspective at SVB, what's driving this? Or you may even want to touch on sort of what you're seeing from the corporate fundraising side as well.
Yeah, absolutely. And I'd love to talk about the corporate side, in particular, the CVC community. But before I do, I mean, to touch on seed, some of the historical trends longer than the last couple of years, I think the last 10 years, have contributed, I think, to at least a slower graduation rate, if not lower. So what I mean by that is when you take even just the median Series A, it more than doubled in terms of its size in the last 10 years. And the same is true for seed, right? So we have started to see a lot more capitalization earlier in a company's life cycle. I think that we've all been hearing about this pressure on VCs to invest earlier and earlier. And functionally, that means more capital before product market fit. And so what you're seeing are a larger cohort of seed stage companies over the last few years that have raised more money that aren't necessarily functionally further along than their sort of parallel peers from 10 years ago. And there is this added pressure that Dave alluded to of those same investors doubling down on their own portfolio, protecting their own portfolio first before funding new companies. And so I do think that even though we're seeing in absolute numbers lower graduation rates, and certainly the benchmarks are moving, some of that is driven by the fact that these companies are better capitalized at the seed stage. And some of that is driven by the fact that those companies have institutional investors at the seed stage that are willing and planning to continue to invest their pro rata. It is also just harder. So those are mitigating factors, but I don't think they tell the whole story. I do think this hollowing out of the middle creates a really challenging environment, to Darren's point, for founders. It is just a fact that sales cycles in the enterprise software space have been longer for years now. So you do have to be creative. And I think that while there are those mitigating factors, the truth of the ecosystem and how hard it is to sell into it is still there. On the corporate side, going to what Darren was saying about how do you get creative, how do you think about alternate sources of financing? I think that the CVC world, and we author a lot of research around the CVC world as well. We'll have another report coming out here in September. It's changed a lot over the last decade or two. There was a big growth spurt within CVC. A lot of companies, large corporates, starting their own strategies and getting really involved in the venture ecosystem early, right? So, I don't have the numbers in front of me, but the old ethos that corporates only get involved at the Series C, D, and beyond when it's been de-risked and there's already perhaps a partnership is sort of old. Is quite antiquated, right? Most of the CVCs that we work with are investing at the Series A seed. At the same time, they've fallen into the same issues that a lot of the ecosystem has. Some of these CVCs that started in the last, call it 3 years, haven't been able to continue, right? So there's been some false starts within the CVC ecosystem, but broadly speaking, they're much, this is smart capital. This is really interesting capital, especially for startups that are looking for partners to help deliver their solution to a broader swath of customers. right? So there's some real interesting value within the CVC world. And we've started to see cap tables where it's actually only CVCs. And that's pretty interesting. We've never seen that a decade ago. And so while there's headwinds for sure, particularly around the seed market, I do think that there's some interesting things happening there.
And certainly, most corporates, right? If they don't have AI native to their offering or their product, they have to kind of figure out what their AI strategy is going to be, right? So this is, kind of I think a center of where we could see more capital coming into the market.
Totally. I mean, like a grocery company doesn't necessarily have access, to Darren's point, to this really strong technical talent, right? It's really hard to compete for that level of talent. So you don't try, right? You find other ways to access innovation, and you find other ways of integrating that into your solutions.
Yeah, great. Maybe talking now a little bit about the reality of scaling AI startups. We talked a little bit about the revenue growth and the high burn here. And maybe I want to start with you, Darren, because I think, just talking a little bit about sort of you emphasized within the report, and I love the quote that you had in there about the trust and explainability remains the major hurdle for adoption of enterprise software. That was probably true even before, but maybe even more emphasized now, or in particular with AI coming to the forefront. So we'd love to have you kind of double click on that quote that you had within our report, how your team is building for credibility in the market, still uncertain about full scale AI deployment, but would love to have you double click on that.
Absolutely. Yeah, because we're in the middle of helping these organizations deploy AI models, we're hearing it every single day that trust is the most critical thing in AI adoption. Without it, if you think about it this way, if you don't trust the results, you're not going to use them, period. So you have to figure out, or what we are trying to do is figure out ways to go about gaining that trust. And we believe that this has to start with transparency across the entire pipeline. We have to trace lineage. Where does the data come from? How do we get the data? What is the source of the data? What is the model that you're using? What is the model output that you're seeing? Being able to identify that. And you can see some of this also if you've ever used like large GenAI foundational models, Perplexity, ChatGPT, et cetera. You can see it thinking like, I'm going to look at this next. That's the same thing. What they're trying to do is they're trying to demonstrate to you, give you the confidence that it's actually reasoning in perhaps the way that you would as a human. So we're seeing that as probably the first thing is ensuring that we have transparency across the entire generation of AI insights pipeline. The next thing I think is really important is to keep the human in the loop. And what I mean by that is you have to give the humans the ability to review the input, provide input into the results, give them the ability to perhaps even override the AI. And then finally, all of your insights need to be aligned to trusted models. For example, NIST, GDPR, CCPA, policies that exist. Being able to comply and demonstrate the compliance with that, I think really helps go a long way.
Maybe again, I think diving into that a little bit, thinking about now, like, does that mean like your go-to-market motion is maybe slightly different than what you were doing maybe with a traditional SaaS company? And like, maybe what does that look like? Are there new roles that people are playing, or is the sale process different?
It's totally different. I think about traditional verticalized SaaS as being a little bit like a VHS tape in a way, where you have it, you watch the same thing over and over again. AI is so broad and it could do anything. It's kind of like a streaming service. You go to Netflix, you can watch whatever genre you want, watch whatever movie you want at any given point in time. It's the same thing with the way we're seeing AI evolve now. Go into a platform, pick a model, pick the data sources, run it. So because of that flexibility and that variation in what you're doing, your team needs to be a lot more technical. I think you have to be able to explain the solution much more clearly. It does require, I believe, more time and evaluation as an enterprise is trying to deploy it as opposed to a SaaS option. Maybe that will condense at some point in the future, but we're definitely seeing that right now. And again, it's really being transparent about the model, because the model insights are really the key. I think it's really, in some ways, we think you have to have third-party evaluation on the insights to detect things like bias, which have to come from a third-party trusted outside source as opposed to something from within. So bringing all of those components into the platform to deliver the insights, I think that's where we're headed. That's what we're seeing right now.
Yeah. Okay. And then thinking about, again, another key factor that came out of the report was, these startups, again, in AI, they're reaching $100 million in revenue faster than we've ever seen before. At the same time, their burn is burning capital just as quickly as they're growing. Thinking about it from either AI squared perspective or how operators should be thinking about that, like how are you thinking about balancing that speed and sustainability at the same time?
Yeah, we're at a moment in time when AI companies can scale faster than ever, with vibe coding and the new tools, Windsurf and Cursor out there. But without discipline, that speed could be a liability because you can lose control and focus. And this could lead to things like bloating at the top or overhiring, overspending. So at AI Squared, and through experiences that I've had from the past, we're really focused on capital efficiency as much as our product velocity. That means that we're really, really obsessing over the value we deliver to our customers. So it's not really growth at all costs. It's about making sure that we can deliver value. We try to measure everything now with paybacks, and only scale what's working. So it's signal from the noise. When we are convinced that there's actual signal, then we will actually do the investment. And I think speed is still important, but it's really the durability. It's building a long-term company that can deliver value that will win at the end of the day.
Yep. Dave, maybe from your perspective, how are the VCs rewarding speed or fundamentals in AI startups today? Anything that's changed in your guys' thesis as you guys are looking at things?
No, I think everyone's just trying to ingest it as quickly as it's happening, getting to billion-dollar run rates in a matter of a few years. It's just mind-blowing in so many ways. I think, when you're thinking about scale versus speed, it's all happening so quickly. The better question, I think, and one that's kind of top of mind, I think, for a lot of investors now is well, what is the quality of that revenue? Is it per seat? Is it usage-based? I think the concern with some of the scale we're seeing today, if it is usage-based, is are you just able to swap a credit card and that's that. Now, I do think there's something to be said, and this might be kind of a hot take about emerging brands in the ecosystem. For instance, on the consumer front, GPT, it's something I automatically will move towards. I think to some extent, Claude is also aggregating some of that brand equity as well. But again, at the end of the day, how are you monetizing and what is the quality? Because that is something that public markets do really take into consideration. I think the holy grail extends beyond SaaS. It becomes outcome based. Eventually, it becomes even labor replacement based. What are we saving in that sense? But for now, I think the big question that we're thinking about is less of, okay, growth versus scale. It's okay, how are they monetizing? What's the long-term plan for that? And how deeply entrenched is this within an organization or an enterprise?
Yeah. Emma, from your perspective, how are you seeing the startups, investors managing the revenue growth, burn rates, consistent narrative that's emerged?
Yeah, I mean, I'll keep it short and sweet. I think that both Dave and Darren touched on things I would have mentioned as well. I think changing revenue models is interesting to see, switching from usage or from seat-based to usage-based, right? But we look as well at that quality of revenue. I think like when something is too good to be true, there's probably something that you need to take a closer look at. So the speed of a lot of these companies' revenue growth also begs the question, okay, well, if it's that quick to grow, how quick would it be to switch, right? And that flexibility that we so admire and love about this technology revolution is also a bit of its Achilles heel, right? And so I think that there's something to be said about the brand equity that Dave mentioned, where, human psychology hasn't changed with the speed of AI, right? So at least on the consumer side, there is an element of first mover advantage, I'm sure. But when it comes down to what works better in an enterprise setting, I'm curious to see where the environment goes in terms of how quick it is to switch things in and out, and making sure that folks are really focused on that sustainable growth, right? Like, what is the quality of that revenue? What are the quality of these contracts? And are you continuing to deliver ROI, and how are you measuring that? So I'll keep it brief on that.
Perfect. And, want to make sure we leave some time to get to the Q&A that's in here as well. So maybe we'll talk and switch to the exit environment, what's going to happen next. Really, I think, exits are the missing ingredient right now in the venture ecosystem. A few comments here. The IPOs have been muted, as we talked about previously. We've seen some M&A start to pick up. but generally it's at the earlier stages, maybe not as many of the doubles or triples that we've seen in the past. You see some of these mega deals getting done. But strategics are looking to acquire talent and some of these things at the earlier stage. We've got the Series A crunch that we talked about, right? So I guess, Dave, from your perspective, what is the most realistic path to liquidity right now for enterprise software companies in the next 12 to 18 months?
Yeah, no, listen, this is evolving in real time. Even this week, you've got Chime's IPO on the docket, and there seems to be some buzz around that. And you have Circle's IPO performing very well. You have Service Titan, eToro continuing to perform. M&A isn't heating up in a material way, but you also have Proofpoint's, Wiz, Informatica, others. So I don't think markets are as cold as they were maybe 12 months ago. They're certainly not open just yet. And I think what's going to, really be the catalyst for that is, again, having a little bit more stability and certainty, particularly around tariffs and geopolitical dynamics, which hopefully we'll have a bit more closure on in the next 3 or 4 months. I think, a broader conversation to have is, well, will all of these unicorns or growth stage businesses go public or get acquired? Or will they want to go public or get acquired? I think 1,400 plus unicorns, 50 IPOs in a given year is a lot. They're not all going to go public. And so I think that brings up a broader conversation about the secondary markets and the opportunity for liquidity there. For us, I think in some ways we view that, is the secondary market the new kind of holy grail of an exit, meaning you just stay private forever. You're out of the watchful eye of public equity research analysts. You don't have to deal with quarterly meetings or the stress that comes with being out there and all the reporting and IPO readiness. And public markets then become, only if you have to. And so I think we're at a real juncture for that and this current dynamic is really forcing that conversation in a lot of ways. I would say from a liquidity perspective, my perspective or point of view is we aren't so far away from that where it's kind of a desperate conversation the growth stage companies are needing to have internally. I do think in 12 months there'll be a bit more clarity, but if anything, I do think this brings up the conversation again about the secondary market's role in venture capital and venture capital backed startups.
And I think it has the potential, right? I mean, Dave, I'm so curious about your perspective on this, but I think it has the potential to be sort of the new private public market in a way, right? I'm sure you're hearing from lots of VMs that is their strategy to exit around the Series B or C through secondary.
Right. I would very much agree. And even some of these, new technologies and innovation that we're seeing, be that AI or even, energy transition, there aren't necessarily always public market precedents. So in many cases, some of the growth funds I've talked to have been underwriting to a secondary transaction at some point.
Is there enough liquidity in that secondary market where it brings adequate liquidity back to the LPs to then invest back into maybe even that mid-size type of funds?
That's a great question. I think as it stands now, not necessarily, but I think we have the real potential to get there soon.
Interesting. Great. Darren, I think maybe, getting the company's perspective here, how do boards, are they talking about IPO and strategic exits now, or is it still heads down build mode? How are they thinking about the timing and optionality? Is that something that's always on the table in conversation at the board?
Yeah, I'll keep it short, but I think that every company needs to deploy like a multi-path strategy right now, where when you're going out there, it's got to be, looking for capital, but also kind of staying tuned to see if there's the potential for a possible exit. I think boards are definitely a lot more open to that now than they have, perhaps been over the last 20 plus years. So, from a company operator perspective, I think it's still incumbent on us to really build real companies that are focused on flawless execution, that have real value again. So, when you're out there, think about those 3 things, right? Running a real company that has real value, that can really sell product on, raise the capital, and if there is an opportunity for an exit, take advantage of that.
Great. Now we've got a few minutes left here in our time allotted. I want to make sure we leave time for the questions that we may have here. So let's pull up Andrew again, if we can, to go through some of the questions that we may have received.
Yep, that sounds good. Let's see, looking through the questions we have in the chat here. And I think this is a good one to start with Darren, with and get your perspective on. We talk a lot about how companies are managing expenses kind of in response to external factors, with scarcity of capital, except for kind of a select few, and then the procurement cycles that everybody's been feeling. This is kind of getting at something more internal with AI. So what are you seeing around needs for funds for early stage companies? The question notes that there are a lot of early stage companies that are leveraging AI to stay extremely lean with a few employees. So I'm curious about the trends that you're seeing there.
Yeah, I think that that's the norm. I think you have to build companies in this way now. Start with AI at the core, AI native technologies. You have to be using the vibe coding tools to build 60% of your code, and then put humans on top of that. So I don't think it's so much unique anymore. I think it's actually required. What I've seen from our experiences in fundraising is that the VCs have reset, what was typically a revenue to headcount type metric. That is totally different now. So they're expecting you to get to, maybe $10 million with 30 people, perhaps even less. So that whole AI at the core is really the new norm, in my opinion.
Cool. And then Dave, you talked about AI unlocking many unforeseen use cases. Can you give any examples of the tech sector, some examples in the tech sector that are growing and attracting capital right now?
Yeah, I think where AI has been most successful has been in highly human-intensive functions. Functions or sectors with a ton of data and repeatable tasks. So it's no wonder that chatbots and searches has been kind of easily disintermediated early on. Legal tech is also one we're seeing an enormous amount of funding over the last 12 to 24 months. And I think more recently, a lot of onboarding and high volume underwriting, be that insurance policy claims, be that applications for specific loan types. So I think those are the most near-term ones that we've been kind of double-clicking on, or at least our managers have, as they're looking out there to invest in the application layer.
And not to put you on the spot, but have there been any areas that have been surprising to you over the past year where you've seen traction where maybe you weren't expecting it?
Somewhat adjacent to AI, but I think the re-rise of hardware, to be honest with you, and defense technology, and I think some of that is we have barely scratched the surface with data and insights in the physical world. There's so much to be automated, so much opportunity for AI. I mean, self-driving is obviously an initial use case of that, but think of all the use cases of geospatial data sets, or insights and access on the ocean, or areas that are just previously undiscovered. And so I think seeing that, and especially with the hardware slam, which is required to collect and ingest this data, has been a really interesting funding trend this year, and we don't expect that to subside in the near term at all.
Yeah, maybe this is a good time for us to plug our Frontier Tech report that we're having out this week as well. And then I see a question here that I think is a good one to end on, and I'll direct this towards Emma. What's the best way for companies to work with SVB to identify early stage companies that are interested in acquisition?
That's a really good question. I would say reach out to your point of contact at SVB. I think that, to Darren's point, every company needs to be thoughtful about how long cycles take, right? So if you're raising capital for your next round, or if you're thinking about consolidation, we are starting to see companies consolidate really early in their stories. And so if there are companies that want to do that, obviously those are very private conversations. So the way that we always handle those sorts of matchmaking at SVB is it's always double opt-in. So if there's an area you're focused on as an investor or as an acquirer that you're curious to learn more about, my piece of advice to you is reach out to your SVB point of contact, and then they'll do their part to research internally where there might be openness. And if there's a double opt-in opportunity, we'll be sure to help create that opportunity. But these are very obviously private conversations. And so our first duty to our clients is to ensure that private information stays discreet.
That's a great point. And I will add, as somebody with boots on the ground, as a main point of contact here at SVB. Always eager to have a conversation and love to chat with startups and founders that I know, but also ones that I haven't met before. So I would encourage anybody to reach out.
Yeah, what I always say to people is, our role at SVB isn't just banking services. We're here to help accelerate the things that would have happened naturally. So if we can help connect you to the right person, we're doing our jobs right.
Cool. I think that's a good place to end it.
Well, thank you everyone for attending. I know that probably everyone on this panel would love to hear from you and get your perspective on the market or what you're seeing. So please reach out. Like I said, we'll be sending the links out to both the state of the markets as well as this recording. So again, thank you for your time today and have a good day.